Okay, fantastic. Well, excited to be here today for another episode of the InsurTech Leadership Podcast. Today's guest is Ty Harris. He is CEO and co founder of Openly. Ty spent more than a decade at Liberty Mutual, leading personal lines product and innovation globally, and then launched Openly back in 2017 to redesign homeowners insurance, specifically working with independent agents. We'll explore his journey from corporate EVP to InsurTech founder, what makes Openly different, some of his lessons along the way, and where he sees the industry going at the moment. So, welcome, Ty.
Thank you so much for having me. Really looking forward to the conversation.
Yeah, absolutely. Again, great to have you on. So, yeah, maybe you could just do sort of the I gave a little bit of a bio, but your version of the highlights and sort of how that led to the founding of Openly.
Yeah, look, I appreciate that. I'm originally a pretty quantitative person, and so I was in grad school in a quantitative field and sort of found my way out of the dissertation writing phase and into insurance as an entry point. Went to Liberty Mutual, as you said, was there a great company. Was there for about 12 or 13 years, and then had the itch to really start something on my own. I think the motivation for that is it's always, I think, partly personal. I just wanted to be on offense even more than you can be at a big company maybe, but also the thesis of the company was that looking around at most of the big successful incumbents, there were two things that occurred to me. One is an insight that I think a lot of people had around that time, which was, hey, there's so much that's possible with technology, and it really is difficult for these, big incumbents to do just by nature of being so big. And in a sense, I'm happy to talk more about that. But I think that maybe the more uh, a little bit more contrarian insight that I think I had was that my co-founder and I had was that a lot of the innovation and technology improvement that was happening at the big incumbents was being pointed toward the thesis that direct sales of insurance is the entire future of insurance, that it's going to be the manufacturer of the insurance, the underwriter, the person taking the risk has to be the same person that has the direct, or the same entity that has the direct connection to the consumer. And I really didn't think that is right. I thought that as a matter of just what adds value for consumers, and you never want to bet against the consumer losing in the long term, right? What it was to have, in fact, a retail layer, if you will, an independent layer between the consumers and the carriers. And so we said we actually think the future of insurance is going to be through independent agents, independent retail. So let's build the most amazing tech-enabled carrier, but specifically built around the needs of this channel, of the independent retail channel. So that's what we've been up to. Like you said, launched, I think it might have been 6 years ago today that we did our first live production quote. So it's been a great journey so far.
Awesome. So, yeah, so that was kind of the most obvious thing that stood out when I was getting ready for this was, a lot of people were going after the agents as opposed to looking to, work with or enable the agents. And that pendulum seems to have, swung back a bit now over the last year or two. So, how did you have the foresight for that?
Yeah, I think there's a basic principle that you can think about. If you've been in insurance, you realize that it's a little bit unlike some other industries. Because, and the reason for that is because every insurance company, every customer is different. I'll put it that way. Their costs are going to be different to you. Every customer represents a little bit different risk. They therefore have, they need a different price, and they also have different coverage needs. And so you're not offering one product or three products. In a way, you're offering like a million different products if you consider the price as part of the product and insurance. And once you accept that, then you say, no given carrier is going to be able to serve most of the market, because everyone has their own risk appetite, their own product, coverage, their own opinion about price. And so even at a big successful direct marketing carrier, you spend all this money to get a customer to come quote with you, which is a lift, because customers don't want to necessarily think about insurance. It's a big lift. They come quote with you, and then lo and behold, like 10% of them you sell something, and 90% of them you don't have the right price, the right product. So understandably, it's not a match, they go away. So it's a terrible waste of their time and of your marketing dollars. And so what that implies is that it's way better for the universe, and certainly for customers, and probably for your marketing dollars, if instead of that model, you say, we're going to have a model where a customer comes to a centralized hub, if you will, or a retailer that can offer them multiple products and match them correctly. And instead of only selling 10% of customers something, they might sell 50% of customers something. So an independent agent is much better positioned to monetize their marketing dollars than a direct carrier. That's in principle, and in practice, what you've seen is that has indeed played out. You see a lot of the big previously captive or direct carriers, and what they've done is they haven't said it in these words, but what I would say is they've almost started to turn themselves into big independent agencies themselves. They've said, well, okay, now when we advertise $1 billion a year on TV and a customer comes to us and we don't have the right product, or we're actually going to open it up and we're going to sell other people's products. So one of our one of our retail channels is in fact other carriers that used to be purely direct, but now they're kind of independent agencies that use their brand to be able to sell other people's products. So it's sort of happening, right? It's empirically occurring now that channel is growing market share. We're in homeowners insurance, and within homeowners insurance is even more so, right? It's been the industry's been growing as a whole, and then independent agents has been gaining share within that growing industry. So it's a great tailwind for what we're doing.
So how would you compare kind of your approach to this to say what like a Bolt is doing, for example?
Yeah, there's different ways. Once you come to this conclusion that there's going to be this intermediate layer of retail that needs to sit between carriers and consumers, there's different ways to build that. You can say, well, we're going to specialize in building you can build the retail layer in there and say we're going to have a call center and actually talk to consumers and sell them insurance. You can say we're going to build some of the technology, kind of a thin layer that does the quoting of the insurance. Maybe that fuels our own call center as well as we can sell that to other people. That's my best estimate of sort of the Bolt model. Is it's kind of a hybrid of a retail layer with a technology, almost a comparative rater sort of enablement layer there. That's one way to address it. What we've done is instead of saying we want to really be that horizontal layer in between consumers and carriers, we've said we actually want to be pretty vertical but thick. So we want to be one of the carriers. We don't want to be the only carrier that's being quoted to a consumer. That's not our goal. We don't want to be exclusive. We want to be one of the carriers that works with all these different retail layers. So we'll work through a Bolt or a comparative rater of other stripes, or it's a progressive agency or a normal independent agency or whatever, through our API, through our UI, it doesn't matter. But what we do then is take it from there. So we say we're going to offer up the best price we can, the best product we can in a given situation, and then we do all the provision of servicing behind, the servicing, handling claims. We do operate, I should say, as an MGA today, but it's a very full stack MGA, if you will. So it's balance sheet light, but it does almost all the functions that a normal insurance company would do. So we're like the carrier equivalent on these platforms, but we make it really easy, super fast and easy, and accurate pricing and low cost and all that, so that we're one of the winning carriers on these platforms.
Got it. And how have you seen the needs of independent agents evolve over the 6, 7, 8 years since you've been working?
Well, yeah, absolutely. There's been a trend, first of all, within the independent agency space toward some degree of consolidation. So you have franchise models like a Goosehead, for example, that are out there. You have big call center, more centralized models that have been emerging. You have even more decentralized models where one giant consolidator of independent agencies will come and buy up smaller agencies and sort of let them run, but they're all behind maybe a shared back office, but
Yeah.
at least shared all that kind of stuff. And then you have the big carriers who have turned it, like I said, turning themselves into independent. So it's certainly a trend toward bigger and consolidation of some stripe. That's one big thing we've seen. Now those bigger, more consolidated agencies, they tend to want some sort of API access or quoting layer in between, and we kind of specialize in that. We love it when people use our user interface, and many of the smaller agencies still do, but we also offer up API access, so that's become much more prevalent demand. The speed and ease, I will say, agents have been willing to make the trade. I think if you've seen some generational turnover, you've seen agencies more willing to make the trade away from a little bit of transparency, to be candid, and toward accepting that for great speed and ease, being able to a quote in 10 or 20 seconds initially, just getting to an answer, yes or no, customized quickly, instead of taking 20 minutes or a day to generate a quote, and maybe being on the phone with somebody that might be more transparent, but it's so clunky that I think most agencies have been willing to give up on that and make that trade.
And in terms of, beside what you just described in terms of the speed aspect, but, helping them sell more, helping them sell better, either analyzing their existing book of business, identifying where they may be at risk of losing a customer, other things like that. Do you provide those? Because I know you have an analytics background, so I'm just curious if you provide those types of, support or services as well.
Yeah, we absolutely do provide some kind of like non-analytics support for agencies in terms of marketing, collateral, obviously that kind of thing. We
Yeah.
also provide we do provide some analytics for them as they think about their book. But I'll be candid. The way we really think about it is these agencies, if they're going to be successful, they probably have their way of doing that stuff, and they've probably figured out the best way to get customers, and it's different for many of them. I mean, many of them are very successful going to the very old school methods, and some of them rely
Yeah.
on new school. What we think we can do best is get them the absolute best insurance product. That's where we specialize. Let's make it great coverage. It's like more comprehensive. It's literally innovative coverage for many customers that they can sell it that way. Let's have put our best foot forward on pricing. So we have a lot of what we built is really sophisticated pricing algorithms. And what that means is we're not going to be the most competitive for most customers, but that's okay because it's so fast and easy. When we are competitive, we can often be very competitive and still have good underwriting results. I think the
Yep.
world is a great place if you have a bunch of carriers doing that. And then let's use technology to drive our own expenses down so that we can be, so that I think a statistic across homeowners sold through the independent agency channel, the all-in carrier administrative expense for the industry for even big scaled carriers is like 40%, including loss adjustment expense. And we're a young company, so ours has been plummeting as we gain scale, but we've kind of crossed through that recently, and we're headed toward a much lower expense ratio as we gain scale. So one of our goals is to get to a direct carrier, a big Geico level almost
Yeah.
expense ratio, even though we're going through this channel, and we think we can get there. So we like to win at the things we're really good at and not try and do too much for the agencies in the part that we think they're good at.
Got it. So you're focused on home owners insurance, and obviously that's a segment that's had some challenges, and certain markets which have had severe losses, and carriers pulling out, and those things. So could you maybe give your insights sort of just on the homeowners segment or line of business as a whole right now?
Oh yeah, man, I feel like I've spent the last 3 years of my life flying around the world talking to ultimately reinsurers in London and Bermuda and everywhere, and just getting obviously getting a really great sense for how we see the market, but also how kind of the ultimate capital behind some carriers sees the market. And it's interesting. Everyone's aware of what I'll call the big headline events. So there's obviously tragic wildfires and giant hurricanes and massive floods and things like that. I think people are aware of that. Maybe people in the industry are aware, but something that flies a little more under the radar, I think, is more in the middle of the country. You've seen over the last few years just a tremendous rise in basic hail losses. I mean, it's so there's some tornado and some just severe thunderstorm losses to accompany that, but it's really, really hail is a thing. And anyone who does business, we're a little bit biased we're in 24 states, but they weight a little bit heavily toward the middle and south of the country compared with the rest of the country. And boy, we have seen that, and many others have. And I think that's caused carriers to take, when you have the coasts with extremely high reinsurance rates and hurricanes, and then you've got wildfires on one coast, and then in the middle of the country you have this hail coming. It's like there's not a lot of places to hide, if you will. And I think that's created one of the toughest home insurance markets in ages. I will say that carriers have taken pretty tough action over the last 2 or 3 years. We are included in that, raising rates substantially. I think you see the industry premium has gone up just tremendously. It was 120 billion a couple years ago, and it's well on its way up toward 200 billion, I think.
Yeah.
And it's raising rates, non-renewing, pulling out. A lot of times carriers won't say they're pulling out, but if you look at it, they're really not quoting. They're telling agents, wink, wink, don't quote in these states. It's not just California or Florida. It's like states in the middle of the country. I
Yeah.
think we're getting changing coverage. I think we're getting toward the end of that. Certainly we are where we're positioned. We feel really good about the tough medicine we've taken over the last couple of years. I think our competitors have been a little slower, but I think many of them are getting to a better spot. I do think the market's softening back a little bit, or it's not hardening as much as it was in the past. So I think consumers will see some relief, although it'll be a higher plateau rate level than it was a few years ago. But I think it'll be some relief compared with it just like every year rates going up and up and up and up and up. So
Yeah. And I mean, I'm curious to just dig into a little bit more around the math, so to speak, and how is it that for a relatively young company, you're already sort of crossing over the thresholds for the standards for the industry, and how are you making those decisions around pricing and what markets you're going to play in, and you said for the people we serve, we do it really, really well. So making those decisions as to who you will serve,
yeah.
going forward.
Yeah, no, the way I think about it, you can think of the loss piece and the expense piece. And when we originally built the company, we have three pillars of our strategy. One is extreme ease, basically. The second one is really sophisticated underwriting through models. And the third is low expense through automation. And the second one, the great underwriting through models, when we first built the company, we built, I'm an actuary and a statistician originally, and we built what was to us a beautifully elegant backbone, if you will, of models. All these 60 perils crossed with coverages, and we take in data from automated sources, all the data in the world to use to predict loss. But what we didn't yet have was the actual experience data. And you can do your best to estimate based on competitors what's going to work and not, but until you have your own real loss data, it's very difficult. So from about 2019, our launch, until for the first 3 years, I'll say it was challenging. And you looked at our loss ratio, it was above where it needed to be. We were still in growth phase, but it was above competitors. In late 2022, we started we suddenly got to that credible point where we started training our own models and feeding these beautiful models more and more data. And ever since that moment, you've seen our loss ratio just plummet down to the point where we're now beating the best competitors out there and continuing to improve. So that's on the loss side. On the expense side, it's I think of how do you not have a really high expense ratio as a young company. On the what I would call like just the overhead side, there's a beauty to starting with a blank sheet of paper without a big built up legacy system of technology. We're somewhere in the 300 million plus 350 of in-force premium right now. So that's not tiny, but it's not scaled either to big competitor size. And I think the fact that we have one product and one technology backbone, and we've repaid some of that tech debt, has allowed us to keep the overhead reasonable. And then we also try and do really clever things on the variable expense side. So we, for example, optimize how we order data. We'll order the cheap data first about a customer or a house or whatnot. And then if the quote isn't proceeding as we expected, then we won't order the expensive data, for example. Or we handle a very high percentage of claims we're able to handle from the desk and not send a licensed adjuster out. We're able to use other tools, human inspectors that are less expensive, or just tools, virtual tools, that kind of thing. That's got our loss adjustment expense way down. Things like that. We try and use tech where we can to trim it down.
Got it. So just shifting gears a little bit here. So I'm curious about your transition from Liberty into a startup role, and part of why I'm particularly curious is that back in the 90s, I helped co-found a fintech startup, and we hired a comparable level executive from MetLife, and we had already achieved some product market fit. We have some known customers. It was a B2B solution, and we were very excited based on his knowledge base, skill set, et cetera. And then he came into a startup, and it was a complete disaster. Like I think had only been dealing with his 7 direct reports for the last few years, and the 1,000 people below that. He didn't have a lot of, sort of in the field knowledge of what was going on. And, he wanted us to take the product out of the market, rebuild it, and go back, which you can do with an organization that's been around for a century and will probably be around for another century. But in a startup, that's pretty much, a death sentence. So I'm just curious, like, were you able to just jump in right away, or was it a tough switch for you, or what was that experience like for you?
Oh, great question. On the one hand, it was what I was excited about, and I've always had very serious hobbies in my life. I'm a hobbyist programmer, and I really did want to be building something de novo, and I knew that was like deep in me, and so I knew I wanted to do it. But having said that, and I think a lot of people who are very successful at a big company don't necessarily have that. They probably have skills that I don't have, but they maybe lack more of that. So I think if you just pick 10 random insurance executives and threw them at a startup, probably 9 of them would have exactly the reaction you had or the experience that you described. So I think some people just want that. But I will say it was very, very humbling and challenging. I couldn't have guessed what I was getting into. You don't understand the structure that you exist on top of when you're an executive at a big company. And I'm sitting in there, year or two or whatever. We still don't have a carrier. We're like begging people for money. I'm flying all over and walking all over cities to meet with people in coffee shops. I used to fly around in jets and stuff, and there's that humbling aspect. And then there's just rolling up your sleeves and, sitting up late on a Saturday with one of our early co-founder employees on the phone about, like literally typing our forms. I'm not a forms guy. But someone's got to do it. And
Yep.
it's so you absolutely, I think some people have the desire to do that. They want to roll up their sleeves. They want to be building something. That's what gives them. And you got to hire people who want that. We've brought over people to our company who are. You really want someone who seeks you out. Who you don't want to be convincing somebody. If someone's
Yeah.
questions are on the lines of, well, they're kind of hinting at what you're describing. That's not the right fit. They may be amazing at a big. You want people who are like seeking you out and saying the right things about rolling up their sleeves and whatnot. And then you can find a good fit. So, but insurance is tough because it's so technical that if you
Yeah.
just hire a bunch of like California startup people who've never done insurance, you can run into real problems. And some insurtechs have that problem as well. So you need to find that 5 or 10% of people at a big company who are good, but also have that itch for the startup life. And I think we've largely done that, but it's you hit the nail on the head in terms of the challenge.
And so you sort of hinted at it there, but anything else in terms of, you know, your approach to the talent strategy, or like, do you have a secret question you ask people to figure out, like, do they have the right mindset to fit into Openly?
Yeah, I in the early days of the company, I spent so much of my time wandering around Boston and sometimes flying to other places and just having coffees and dinners with people. It's when you're the initial hires in a company are so critical that you cannot afford the kind of hiring mistake that you're often going to make in a big environment. Now you're going to make some mistakes and you got to act on that really quickly. So, but anyway, it's absolutely worth your time to make as a founder to make it a huge portion of your initial days, nights at the company, getting to know people really well. I also, this is a little contrarian, but I actually, or I don't know, contrarian, but I do think I hired some people that I knew and had worked with, and I think having worked with somebody is the best interview you could, or you could possibly do. You don't always have that luxury, and at least you can sometimes get oh well, let's kind of back channel and find out. In terms of secret interview questions, I think I don't know that we had a secret question, but I just it's the I'll tell you, the people who the people who were maybe best in the early days were people who were you'd seen operate in a corporate environment, and they really worked hard and got stuff done, but maybe they weren't that super polished presenter to the board that is kind of a overweight or heavily weighted, I'll say, in a big company. I think
Yeah.
that there's a lot of need for that, and there's a little bit you can index a little bit differently and not pay people the $5 million salary, but still get amazing people if you're willing to give up just a little bit in terms of their experience at that. So that's probably a little bit of what I look for. A little rough around the edges, but then like willing to roll up the sleeves a little more, I'd say. So.
I was talking to another founder, and he was arguing that your first hires kind of need to be generalists in some way. And it and I think he's right, or at least um, willing to be generalists,
Yeah.
even if you're bringing them in for a certain specialization, which, as you pointed out, is critical in insurance because it is highly
Yeah.
regulated and so nuanced depending on your line of business and exactly what your model is and all those things.
No, you're right. That adaptability is like so critical. We brought people in who thought they were doing like a strategy role. I don't know that you really need strategy when you have 15
Yeah,
people.
right.
We brought people in because they were amazing talent, and then it turns out their first job was to create the Google sheet that had the bills because we weren't. It turns out we're not collecting any money.
Yeah,
How do we do that? Okay, figure it out. And stuff that just happens over and over. So yeah, if someone's out there thinking about hiring for a startup, I would absolutely emphasize the general adaptability, the athlete in someone at being an operator and an adapter, as opposed to just a specialist. For
yeah.
sure.
So Ty, really appreciate you taking the time to speak. Is there anything else that we haven't covered, or anything else you'd like to share before we wrap up?
No, look, I think we covered it. If there are independent agents and customers out there listening and hearing about openly, I guess my message is we've been through some tough work together, getting our underwriting results in shape. We're now at the end of that tunnel, and we're really excited to be growing all of our employees and agents and customers and whatnot. Really excited to be back in what I'd call full-on growth mode, and excited about the future. And I really appreciate you having me on today. It was great.
Absolutely. All right, great. Well, Ty Harris, CEO and co-founder